India is at the cusp of a financial revolution set to welcome billions in foreign capital. On June 28th, India achieved a historic milestone by officially joining JP Morgan's prestigious Emerging Market Bond Indices, marking an entry into the vast $1.3 trillion global bond market. This move has elevated India's sovereign debt to a highly coveted asset, setting the stage for a substantial inflow into the capital into the country. JP Morgan announced in September last year that it would include 23 government bonds in its Emerging Market Bond Index. Over the next 10 months, starting now, it is expected that passive allocations to Indian bonds could amount to approximately $25 billion, signaling robust investor confidence and interest in India's economic prospects. Since the announcement, foreign portfolio investors have poured a remarkable 1.1 trillion rupees into India's debt market, and this surge in investment activity is driven by expectations of favorable yields, especially amid Reserve Bank of India's proactive stance on maintaining high interest rates in anticipation of the bond index inclusion. Remember, bond prices and yields have an inverse relationship, so when the demand for bond is high, their prices surge and the yield drop. As a result, the yields on the 10-year bonds have eased by about 20 basis points since the inclusion announcement. Experts expect the yield on the 10-year to trade in the range of 6.85 to 7.05% going forward. And even though the yields will ease, the differential compared to other emerging markets will also attract active funds and further stabilize the rupee. According to experts, the usual trend of currency depreciation due to India's trade and current account deficit is unlikely to repeat in the near future. Moreover, India's inclusion in JP Morgan Index aligns strategically with the government's broader economic agenda. By aiming to reduce fiscal deficit and borrowing in the current fiscal year, the government intends to create a conducive environment for private sector-led growth and innovation. This anticipated influx of foreign capital will further support this initiative, providing the necessary resources for the country to expand and thrive. Apart from the JP Morgan Index, Indian bonds will also be included in the Bloomberg Emerging Market Indices, which could bring inflows of about $5 billion from passive funds as well as more from active investors. While the benefits of India's inclusion in the global bond market are substantial, it also poses certain challenges. The influx of foreign capital could potentially increase market volatility and lead to currency appreciation risk. Moreover, maintaining higher interest rates to attract and retain foreign investments may inadvertently raise borrowing costs for domestic businesses and consumers. Effectively managing these opportunities and challenges will be critical in ensuring substantial economic growth and stability for India in the global economic landscape. As India continues on its trajectory, striking a delicate balance between capitalizing on newfound opportunities and mitigating associated risk will be essential for navigating its path towards economic prosperity and resilience.